I want to introduce our guest for today. So, Prabhakar Kudva is co-founder of Samvitti Capital, and he has over 20 plus years of market experience. And he has tried almost every style of investing which you think is prevalent in the market, and he is more focused on finding out the catalysts or which you say triggers so as to generate good returns in comparatively lesser time. So, Prabhakar, I would request you to set a backdrop for attendees and additionally, what they can expect from today's session. And if possible, we can summarize the previous session which we did a few months ago.
Yeah, sure. So thanks, Prince, for organizing this. Mm, So quick disclaimer, before we start. Although Prince already mentioned it, but so so my firm is a SEBI registered portfolio manager. So goes without saying, whatever we discuss tonight, it could be concepts or it could be stocks or sectors. Me and my clients will have positions in them, and we can buy and sell those positions without any notice. And also whatever is discussed, please take it with a spoonful of salt. uh, do your own due diligence, because a lot of strategies and setups that we speak about are not applicable for all risk profiles. So I think you should do your due diligence before implementing anything that we speak about. So with that backdrop, so I wanted to talk about this particular setup, which I call the earnings explosion setup. I'll probably take 20, 25 minutes to just talk about this, and maybe then we can open up for questions. But before we get to the actual setup, I want to discuss two very important ideas, two very important concepts which are applicable across the market. The first concept is that of a setup, the idea of a setup. So basically, what is a setup, right? A setup is actually a pattern that is based on a structural tendency of the markets, and hence that there is an edge in that. So everything that you do in the market, should actually be a setup. So you might be a value investor or a growth investor, or might be an option trader. So whatever you're doing, the market has to be based on a setup, and the setup itself should be based on some structural tendency of the market. So when I say a structural tendency of the market, it means certain behavior that the market is likely to show predictably. So, there are many structural tendencies that the market exhibits, and one such tendency is what this earnings explosion setup is based on, right? So, what exactly is a setup, right? So, a setup should, like I said, be built on the foundation of a structural tendency. Other than that, the setup should clearly define what pattern are you looking for, right? You should have crystal clarity about what exactly you're looking for. It should define when will you pull the buy trigger. It should define how much are you going to buy. So what is your portfolio allocation like? It should define when will I continue to hold. And of course, it should define when will you sell and how will you go about the selling process. So only if there is clarity of thought around all of the above for any given setup, will we be able to utilize the edge and make meaningful profits. So these are the broadly the questions, what to look for, when to buy, how much to buy, when to hold, when to sell. So we will try to, look at all of these questions in, pertaining to the earnings explosion setup that we will discuss. So the second key idea, other than the idea of having a setup, is the idea of understanding the impact of market environment. Now, every setup, right, has a different probability of success. Not only that, every setup has a different probability of success at different times in the market. So the probability of every setup changes based on the underlying market environment. So, for example, whatever setup you're trading in the market, like I said, if you're a value investor, a certain market environment might favor you. If you're a breakout trader, a certain market environment might, favor you, and a certain market environment may not. So, it's very important to have a mechanism or have a process to come up with a thesis to understand what is the current market environment in which we are operating. So in a good market environment that is conducive for your setup, you might have an 80% success rate. And the same setup in a different market environment might give you as low as 10 or 20% success rate. And this applies to all the different setups that people trade in the market. So this is a very, very important concept. Without understanding the underlying market environment and how it pertains to your setup, you will tend to make a lot of mistakes in terms of, when to be aggressive, when to be less aggressive, your position sizing. So all of that are a function of the market environment. So these are the two, main things that you have to keep in mind, that you should have crystal clarity around certain questions, that you should be very clear what is it that you're doing, how are you going to do it. And second, you should have a sense of in what environment am I operating, and what does it mean to the probability of my success in the current environment. So these two concepts are general in nature and they apply to any strategy that you do. But I felt that this is something not a lot of people think about. A lot of retail investors, they actually lose money in the markets or don't do as well as they would do, is because they don't have a thought through setup. They are trading very randomly. There is no process, and they keep jumping from one setup to another setup. So spend some time thinking about these two concepts, and I'm sure that will make a very meaningful difference to your overall investing and trading experience. So with this background in place, we can sort of get into the actual meat of the discussion, which is the earnings explosion setup. So Prince, shall I continue?
Yeah,
Sure, sure. So let's get into the earnings explosion, the setup itself, right? So like I said, every setup is based on a structural tendency. So what is the structural tendency on which this particular earnings setup is based on? So this particular setup is based on the tendency of the market to meaningfully adjust the valuations and the prices whenever there is a surprise event. So I have studied, several years worth of stock winners, and you can do that too. If you go back, if you study this year's winners, or if you go back to the last year's winners, or if you look, even in the 1990s, or you look in the early 2000s, if you make a list of all the winners, what you will find is that there are two main reasons for any large rally in the market. And the two main reasons are there is an actual surprise in the earnings. That's reason number one. So there is an actual improvement in the earnings in a significant manner, which forces the market to re-rate the stock. And the second is that there is an anticipation that the earnings will surprise. So it has not come about in the numbers yet, but there is an anticipation that the earnings will surprise in a meaningful way. So just to give you a quick example, right? So actual surprise and earnings. Let's pick something which is very recent so that you can relate to it. So PSU banks and some of the other tier two banks like Karnataka Bank, J&K Bank, I think Axis Bank are good examples of an actual surprise in earnings. So in the previous quarters, they reported blockbuster earnings. The earnings were completely out of the park, and the market went about re-rating them in a large way. Now, in the same sector, many banks actually did not report good earnings, but still the prices went up. And the reason for that is the second reason that we discussed. It's an anticipation rally. It's a rally in anticipation of good earnings in the future, right? So what the market is saying that, okay, because the peers have done well, it's kind of obvious that these companies also should do well, which may or may not happen. But the part of the stocks have run on actually reported good numbers, and part of the stocks have run up on what is called as an anticipation-based, rally. Another example would be, a famous example, if I have to give you, is the Adani Group rally, right? So the Adani Group rally can only be explained by anticipation. Now the stocks have gone up 5, 10, 15x, 20x, across the board in the Adani Group. And if you see the numbers, you can't make sense of the numbers. The numbers are just not there. But there is an anticipation by the market, definitely driven by some, theses that the market has, that these companies, Adani Group companies, will become very large in terms of the numbers also. They will build out the physical infra for the entire country. So there is some anticipation of the earnings, but the actual earnings is not there. So the second category of stocks is often called as story stocks, right? Or based on some, the rally is based on a story or a narrative. And a lot of times you will see that it is the story stocks that will actually perform better in terms of the returns than the ones with the actual earnings. And the reason for that is psychological. In the absence of hardcore data, like an earnings release, prospective buyers will stay away, wanting to get clarity, while those who took the risk will be rewarded if they're proven right. So you will often see that stocks which are running in anticipation of earnings based on some news or some other trigger will actually outperform, a lot of times, not all the time, but a lot of times, the stocks which have actually given out good numbers. So, but as is the case in the market, if there is a higher reward at some point in time, the market will also test your ability to stomach risk. So, with these story stocks and narrative-based stocks, you have to expect a lot of volatility and uncertainty. You should be able to sit through a lot of sudden painful attacks to be able to make money. So, these story stocks need a different mindset and a different risk management policy. And these story stocks are not really a topic of today's discussion, but I wanted to put it in place, to have an idea of completion of thought. So there are two kinds of earning surprises. One are actual, and one is anticipatory in nature. So let's focus on the first category now, right? So where there is an actual earning surprise. So one of the questions in the setup discussion was that what exactly are we looking for, right? So what exactly is the pattern that we are looking for? Now, the pattern that we're looking for has a number of items, right? You can think of it as a checklist. So the first thing that we're looking for is a big jump in the revenues versus last several quarters. So you want to see, I will not quantify it, but there has to be a meaningfully big jump in revenue versus the last several quarters. That is the first criteria. The second criteria is there has to be a big jump in operating profit versus the last several quarters, right? I'm not saying net profit yet, because a lot of times there is a lot of activities which happen below the EBITDA level, which depress the earnings. So you have to look at the operating profits, and eventually, in a lot of companies, it will flow down to the EPS, but what really matters are the operating profits. So you want to see a big jump in operating profits for the current quarter versus the last several quarters. So what both of these jumps will mean essentially is that there has been a big jump in the margins. So when there is a big jump in revenue and there is a big jump in operating profits, often the jump in operating profits will be much higher than a jump in the revenue, and that will be happening because the margins of the company has expanded, right? So there has to be an improvement in the margins. Now the market is very kind to companies which show an improvement in the margins, because the improvement in the margins gives rise to a huge operating leverage, which eventually translates into a much higher growth at the EPS level. Now let's break this down a little bit. So when I say improvement in margin, again, there are two types, right? So one is that, let's say that the company was doing, let's say 4 or 5% operating profit margins in the last several quarters, and suddenly the operating profit margins have jumped to 7%. So from 4 or 5, they've jumped to 7% in this quarter. So, which is good, but what you have to also go back and check is what is the highest margin that this company has done over the last several years. So annually you will see, if you should see something like, okay, the maximum margin that this company has done is about 12 to 13%. So now you know that, okay, they were at 4 or 5%, now they have done 7%, and in the past they have reached a margin of 12, 13%. So there is a possibility that the 7% can go to 12, 13%. So there is an upside delta there to be made, right? So that is one way of looking at margins. In some companies, what will happen is, this first thing that I told you will happen more in these value companies, right? The cyclical companies, where they will see very depressed margins, and suddenly when the cycle starts turning, they will see the margins start expanding, and that will be just be the beginning. And from there, the margins can expand all the way back to the historical high levels of margins that they have seen at the peak of the previous cycle. So that's one way of looking at margins. The second thing that you will encounter is, let's say a company is doing margins of let's say 7-8%, and suddenly the margins go to 15-16%. So those are cases where something special is happening, in terms of the tailwinds. So, typically you see this in the chemical companies and all of that. We've seen that, either because the raw material prices have crashed, but they have been able to hold on to their pricing at the top line level. So you will see the margins expand, significantly. This happened to the graphite, the electrode stocks. I remember back in the 3-4 years back, where the margins went super high and the margins stayed there for a few quarters before again reverting back to the mean. But if you caught it in the first quarter, right, there was significant money to be made in these stocks. So these are the two types of margin expansions you will see. You probably make more money in the second one, whereby the margins have really shot up, and if they sustain for a few quarters, then the profitability of the company can really go to the next level. So again, just to quickly recap, there are these three things, right? So we're looking for a big jump in revenue, we're looking for a big jump in operating profits, and we are looking at an expansion in the margins in the context of the two things that we discussed. Now, the other thing is you have to find this. This should be the first or the second quarter where this kind of a jump is happening, right? Anything that is beyond the second quarter, if something like this happens in the third or the fourth quarter continuously, then that story is already stale. The market should have already re-rated the stock, and there is nothing much left on the table for you. So you want to see this happening in the first or the second quarter. So why I say the first or the second quarter is, the first quarter by definition is a surprise quarter. But sometimes what happens is, a lot of companies, right, the market doesn't trust them. So the market waits for the second quarter's confirmation to really go out and re-rate them. So, so you have to keep this in mind. So whenever you see these big jumps, you have to be in the first or the second quarter. Anything beyond that, and you're getting into a slightly risky territory, right? So these are the sort of the quick fundamental checks. Of course, there are nuances in this, but broadly, this is what it is. Once you pass these revenue, operating profits, margins check, and you've established that this is the first or second quarter of the jump. The next thing is the price based checks, right? So now whenever a surprise earnings comes up, right, the market will behave differently in different market environments. So if it's a bull market, what you will see is that if the basic checks are in place, you will see that the stock will gap up and it will never look back. It will just gap up and it will just straight up go 20, 30, 40%, right? If your thesis is right, and if the market is in sync with what you are seeing, right? However, in a bear market, what you will see is that it will open gap up as usual, but the gap will fade, and the stock will remain range bound, for as long as the market, the overall market takes time to recover. Of course, there will be some exceptional stocks which even in a bear market will do well, but because we're talking about a general rule here, in a bear market you have to expect a gap up and a fade. So you should be a little bit more careful in bear markets. But in a bull market, you should always see a gap up and the stock should not look back, right? Now, if the stock if we are in a bull market and the stock gaps up and then fades, then that's a warning sign. That's a sign that the market is not agreeing with your thesis. So you have to either think twice about your allocations, or you have to give that stock a pass. So you cannot be as confident as you would be if the market agreed with your thesis, right? So basically, like I said, the market environment will define how, so in a bull market, you have to expect a gap up. In a bear market, you have to expect a muted reaction. So just because the stock has a good earnings and we are in a bear market, do not expect the stock to just take off. It will not, right? That is not a part of so if it is not going up, it's as per the expected behavior in a bear market, right? So other than price, I think the volume is also a key indicator, especially the volume on the first day. So if the results have come yesterday night and today morning, you will see that there is a super high volume which is at least 3, 4, 5x higher than what it was doing in the last few days, that tells you that money is flowing into this stock. But super high volume without the appropriate price action is not very meaningful. So volume is a good to have if it is in sync with the price, right? So once you have all of these checks in place, you will have a fair probability of success in this setup. However, how can we improve our odds further, right? So what are the things we can do to improve our odds further? So if you see that multiple companies in the same sector are giving blockbuster numbers, then you can be very, very sure, or rather much more sure, that you are on the right track. And again, this happened with the PSU banks. Now it happened with the IT companies last year. The large cap, mid cap, small cap, everything did well. So if it's a sectoral improvement in earnings, then you can be much more confident that it is for real. That you can actually go out and bet on it. So that's one of the qualifiers to improve our odds, right? So if you find this in one company, it's okay. I mean, it's still a good probability, but you can improve your probability if you figure out that yes, this is happening across the sector. What happened with paper a couple of quarters back. So that's one. Second is, if you have a choice between doing this on a smaller company and a larger company, I think you have to choose the smaller company, because smaller companies make bigger moves. Now, of course, if you're restricted by your size and all of that, then a lot of smaller companies will be out of your universe, because you just can't trade companies which are too small or which they don't trade enough volume. But I think for most retail investors, that should not be a problem. So if you have a choice between a small company and a large company, pick the smaller company. We'll talk about allocation a bit later, but pick the small company, because smaller companies by nature make much bigger moves, when things go right. The next qualifier, is, I think, recent IPO. So, recent IPO, is also something where there is not a lot of ownership. There is not a lot of ownership. Something that is IPO'd in the last 2, 3 years, and suddenly you see, very good earnings. So those are also good high probability candidates for big moves. Just to give an example, now if Paytm comes out with blockbuster numbers, in one of these quarters, then it can be a good candidate, because a lot of selling that has to happen has already happened. A lot of people who bought in the IPO have probably, sold. And a lot of new investors, have not yet participated in this company. So IPOs have certain structural benefits. So IPOs are one more qualifiers, and the fourth and final qualifier is low float, right? And we saw the example this time in the likes of UCO Bank, right? If the float is low, it's very easy for the buyers to take control. And if a good news and the float is combined, right, you typically get very explosive moves. So these are the four qualifiers which can improve your odds. A sectoral move, a small company, an IPO, or a low float. Even if you don't have any of these, it is okay. You still have a good probability if you've got your earnings analysis right. So this is what I'm looking for, right? So this is the pattern that I'm really looking for. Now, when should you buy? So my experience has been, you have to buy immediately post results. Now, if the results are overnight, then you have to buy within the first 30 minutes or 1 hour, right? If it qualifies all your criteria, right? Now, of course, this is a choice, but you can wait for the stock to really prove itself and all of that. But all said and done, you have to buy within the first day, right? So even if the results came during market, you have to buy at least within the next day. If the results came overnight, you have to buy again within the next day, but within one day you have to do the buying, because if the market is conducive, then these stocks can very quickly move up 20, 30, 40% before taking a pause. So if you've got the right stock and you think everything is checking out, then you have to try to buy as soon as possible, right? Now the question is, how much should you buy, right? Now the question comes about allocation. So my experience has been to stay diversified with this approach, because I feel diversification brings two things to the table. One is, it brings a built-in risk management. because your allocation sizes are small. So even if something doesn't work out, it doesn't really impact your portfolio in a large way. And second, it brings in optionality, right? So I've spoken about this multiple times in the past, that, if I ask you to rank 10 stocks and, which would be the best performers for the next year, it is very likely that the stocks which you feel, are your, rank 7, 8, 9, 10, some of those stocks will turn out to be the best performers in that list. So when you diversify, you open yourself up to optionality. So I might find, let's say 10 stocks or, 20 stocks, and the 17th, 18th, 19th, and 20th stocks that I buy, I'm just buying because, everything is in order. But I personally don't believe that, they might do that well. But the earnings seem good, and there seems to be, a significant improvement. And what really happens, I've seen time and again, is that those exact stocks, end up becoming your biggest winners the next year. So by staying diversified, you are opening yourself up to, this optionality. So and the second thing is, because in this setup we are primarily dealing with mid and small cap stocks, right? Because that is where the the big moves are. But we have to bet smaller. So a portfolio of 20 25 stocks, I think should be fair. So anything around 20 to 30 stocks should be, I think, good, which takes care of risk management as well as gives you a decent optionality. Now there are certain very experienced people who are skilled at this, can concentrate, but that can happen only during a bull market. So if you know that the market is very good, and you know that anything that is good will, really take off. In such cases, if you are skilled and you can have a proper logical stop loss in place, you can concentrate. You can take a big position, because some of these stocks really take off. So, but I would not suggest that to, a regular person who's just starting out on this. And when I say a logical stop loss, right, the stop loss is something that is very misunderstood, right? So when you take a large position, what is a logical stop loss? A logical stop loss is, not 5%, 10%. It's not a random number. A logical stop loss is the stock should not come back to the price where it was there pre-results, right? So that is a logical stop loss. So the stock, so let's say the good results have come and the stock has gapped up. Now you don't want to see its price come back to the previous range, because that means that the market is giving you an opportunity to buy the stock, uh, at the pre-news price, which doesn't make sense. Ideally the market should not give you that opportunity. So that, if it comes back into the previous, then that should be a stop loss, and that is the stop loss which a concentrated investor should use. A diversified investor should not use any stop losses, because, like I said, the diversification itself is a risk management exercise. And a lot of times in mid and small cap stocks, corrections of 15-20% are normal. So you cannot, so cutting your position after has already fallen 20-25% doesn't make, much sense. Especially, if there is a market correction like the one we are going through right now, you will see a lot of stocks with good earnings also fall, 15, 20, 25%. So you cannot have the stop loss business, if you're diversified, and which is another reason why I prefer staying diversified. But just again, for the completion of, discussion, I said that you can technically concentrate if you are skilled enough to, have a, higher probability than a normal person, and also have the ability to cut and book your losses if the trade is not working against you. Right. So this is about how much will I buy, the allocation part. And, so when do we continue to hold, right? So as long as the news flow inter-quarter, there's no news flow that comes inter-quarter that poses a risk to the earnings of the company, we should hold on, right? For example, a chemical company, right? If there is a serious increase in the raw material prices inter-quarter, right? Then you have to evaluate. Then you cannot just sit on it and, you have to evaluate, because something has changed which can completely change your thesis, right? So please remember, what is your thesis? Your thesis is that the company has given a good quarter, and you are taking a bet that this good quarter is going to continue, right? And if it continues, or if the market thinks that it will continue, will you make money? But if some event has happened which puts that thesis to risk, then you have to really reevaluate and look at exit options. So similarly, if there is an event that impacts the entire sector, some government policy change inter-quarter, something comes out, then you have to really reevaluate and not hold the stock. And finally, we'll come to, when do you go about selling, right? So selling should be done in one of the below scenarios, right? So the result momentum weakens considerably, right? So this is obvious, right? So if you bought because you're expecting the good results to continue into the second, third, and fourth quarter, but if the result momentum weakens considerably, you should just get out. You should not even think about it, again. The second time to sell is if you are in the fourth or the fifth quarter of good results, right? So generally, these rallies will finish in 3 or 4 quarters. So what started in the first quarter will finish by the third or fourth quarter. So if you are in the fourth or the fifth quarter of good results and you're sitting on significant profits, then you have to look at booking your profits, because the improvement has already taken place and the improvements cannot go on forever, right? End of the day, it's a business, right? A business is a real world entity. Now you cannot have continuous increases, right? Like they say, right? So trees don't grow to sky, right? So it's the same concept. So at some point you have to say, okay, we've had a good run, and of course the delta improvement cannot be very high in the from the fourth or fifth quarter onwards. So that's one checkpoint for you to look at exits. The third one is if the results are so good and the margins are so high that it's hard to significantly improve on the numbers, right? So a lot of times that will happen. In the second or the third quarter, you will see that things have gotten so good that it's just too good to be true, right? So something like that happened with Fine Organics and Tata Elxsi. I think Tata Elxsi also qualified for the fourth or fifth quarter of good results, and post that we saw what happens. But I think I even made a tweet, even significantly before the results, that if this Tata Elxsi disappoints, then it's going to have a very sharp fall, right? Because after a significant improvement in the margins, you cannot expect it to go on forever, right? So mean reversion is one of the natural tendencies of the market, and which will catch up with everybody, right? So Fine Organics also reported very good numbers for 2 quarters in a row, but the margins were so high and the numbers were so good that if you use common sense, you know that okay, there is from here I cannot expect any more incremental data, So and Fine Organics, has corrected quite a bit, right? And finally, if none of these have qualified, but you're sitting on significant profits, right? I think you have to take some money off the table, because it's very, very important to, understand that this is not a buy and hold setup, right? So we are not buying, a HDFC Bank or an Asian Paint here, right? So although they might qualify sometimes as, for the setup, but these are candidates which are being temporarily re-rated, right? So please understand, it's a temporary re-rating, and the re-rating in most cases will not stay forever. Hence, you have to take money off the table, especially as they become stale. So when I say stale, I mean as you get into the third, fourth quarter, you have to seriously start looking at taking money off the table. There will be exceptions, one or two stocks which will continue to do well, but you cannot build a strategy around exceptions. So you have to take some money off the table, especially when you get into the third, fourth, fifth quarter, right? So I think that's it. When to sell also we've covered, right? So yeah, so I think that's about it. I hope this helped, right? Now since this is a voice only thing, I could not go as deep as I wanted to, right? So I plan to do a Zoom call sometime on this.